talk about asset managers and how they're facing an existential crisis. And that's because for years, investors have been shifting their money into passive funds. The move has pushed down fees, led to job losses by the thousands, and forced large-scale consolidation. The industry is on the brink of a shakeout, and it's one in which only the strongest will survive. Annie Massa co-authored this exclusive Bloomberg story with some stunning numbers. And Annie, a lot of people chalk this up to why the days of superstar fund managers might be over as well. You're not going to get the Peter Lynches or the Bill Millers or the Bill Grosses of the world anymore. Talk first of all about why index funds in particular are so attractive right now.
Sure. One of the big attractions of index funds has been fees, plain and simple. A lot of low-cost index funds have hit the market in the past 10 years, and there's been this flood of money into cheap index products. And as we can see through the fee wars between these different asset managers, the cost for those products are just going lower and lower. At the same time, active managers are having to work harder and harder to prove their worth to customers.
And so is the answer to be all things to all men and women and everyone? The Vanguards, the BlackRocks that basically offer passive and active, is that the only way to do it?
That's certainly one option, but you can't have so many huge asset managers at once. So you definitely see BlackRock and Vanguard. These firms have trillions of dollars in assets, and they do offer, they run the gamut from actively managed funds to index products, but both are giants of indexing, which has helped them in the past 10 years. On the other end of the spectrum, you also have small boutique firms who are very niche and focused. So you can go one way or the other, but in the middle, you're going to encounter some problems.
You're going to encounter some problems, especially in equities, because the S&P 500 has done so well. It's hard to outperform that. You have to at least keep pace with it. It's easier, though, in fixed income to go active and to stay active, isn't it?
That's right. The past 10 years have been especially good for equity index products because you've seen this 10-year bull run. Fixed income is interesting. There's definitely some new indexed fixed income products hitting the market, but they haven't come quite as far in terms of indexing as we've seen in equities. So there's still, for sure, active dominance there.
We're looking at the outperformance of, well, the lack of few active funds that have outperformed the market in European equity funds and US large cap funds. Europe's interesting. There aren't that many big players there, are there, in terms of asset management? There's only one that's managed to get $1 trillion under its orbit.
That's exactly right. BlackRock, Vanguard, State Street, these largest global asset managers are all based in the US, and part of their strength has been that they have, in some cases, like BlackRock's, over $2 trillion in index products. So that really helps their case.
You know, what I find interesting in this whole conversation is we talk about how much assets have moved over to the passive side, but even the reported numbers that are under management at active shops is not quite the full story, because the value of the assets have grown because asset prices have increased as well. So it's not like they're adding new customers or anything. It's just the assets under management have increased. They've swelled because the market has been going up.
That's a really good point. And one other thing that we mentioned in the article is this age of really picking star fund managers based on this star power really is fading. And as we just saw with Neil Woodford, for example, sometimes that can really work against you. And sometimes investors aren't so sure what's actually in their funds that they're buying.
Right, because they need to go out and justify their fees. They go look for illiquid stuff to invest in.
And then people want their money back. It doesn't always quite twin up. The end game here, consolidation, is that where we're going?
We have a big section in this story on consolidation. You've seen already in this fallout from all these changes and all these trends. You've seen a lot of consolidation. You saw Invesco buying Oppenheimer funds. But as we mentioned in this story, it doesn't always work out. Janus Henderson and Standard Life Aberdeen are both situations where you've seen actually outflows in the immediate aftermath of those examples of consolidation. So sometimes deal making isn't the only answer.